Welcome back, dear traders. Wall Street is trying to shrug off fears and poised to open a new week on an optimistic note. There is a good news that cheers up market sentiment, though the market is alert to any crack in the banking sector. The benchmark stock indexes managed to close a highly volatile session on Friday with gains. Fed policymakers' comments made in the late New York session served as a sedative pills. Investors regained optimism that enabled a modest growth in the major stock indexes on Friday. The Dow Jones added 132 points, or 0.41%. The Nasdaq climbed by 0.31%. The S&P 500 rose by 0.56%. to close at 3,970 points. The benchmark indexes are poised to open a new trading week in the green. All of them traded higher, having grown by 0.3 and 0.6% in the New York pre-market. The S&P 500 is expected to trade in the intraday corridor between 3,940 and 4,040 points. All three US stock indexes opened on Friday in the red, in a parallel with the European shares. However, Wall Street investors reversed sentiment after comments from the Fed officials. President of the three regional Federal Reserve banks confirmed that the U.S. banking system was resilient. They also did not rule out further rate hikes, thus inspiring confidence in the U.S. economy. Besides, analysts at J.P. Morgan dispelled concern over problems with the counterparty and liquidity issues. Shares of the large American banks, J.P. Morgan and Wells Fargo, recouped their losses, though closed in the red. At the same time, Bank of America logged a positive dynamic. Shares of regional lenders such as the PacWest and Western Alliance grew by 3.2% and 5.8% respectively. Shares of First Republic dropped by 1.4%. The banking sub-index of the S&P slipped a bit on a Friday, whereas the index of domestic banks jumped by 2.9%. The 9 from 11 sectors in the S&P 500 closed with gains. Despite turbulence in the financial markets, all three US stock indexes gained ground. Wall Street logged weekly growth last week. Moreover, the S&P 500 and the Nasdaq on a track to their quarterly growth. First Citizens Bank said on a Monday that it would purchase a stake in a Silicon Valley bank. Shares of First Citizens surged by almost 11% in the pre-market. Shares of First Republic leapt the nearly 27% after the news that the U.S. authorities are searching for extra measures to support banks. Shares of other regional banks such as the Western Alliance and the PacWest also rose by 5.4% and 9.2% respectively. Shares of J.P. Morgan, Citigroup and the Bank of America grew by 0.8% and 1.4%. Shares of European banks also recovered after a slump in Deutsche Bank's shares last week. They regained roughly 3%. UBS shares fell by 1%. The market response indicates its vulnerability to the news on the banking sector. It means that concerns over a broader crisis have not ebbed away yet. The stress in the banking sector could escalate into a full-blown financial crisis and spark off a sharp slowdown. Investors pin hopes for a pause in the cycle of rate hikes that could be announced by the US Fed in May. The economic calendar is loaded with economic data, including a consumer sentiment index and the US CPI that could shed light on the Fed's agenda. The essence of the US problem is massive deposit withdrawals from smaller banks in favor of larger, better supervised competitors. The inflow of funds expanded to a record $5.1 trillion last month. Deposits in smaller banks on the week ended March 15 contracted by $120 billion and borrowings and surged by $253 billion. Analysts suggested two scenarios for regional banks, either a considerable increase in deposit rates or a sharp cut in lending that might entail a credit crisis in the economy. The good news is that the capital flight to cash funds assured the U.S. Fed to soften its monetary policy in the past. Now, Fed funds futures indicate the odds that the U.S. Central Bank will hit the pause button in May. The Federal Reserve should adjust the decision to the banking stress on the one hand and to high inflation on the other hand. The Fed policymakers will be alert to the PCE price index for February, released on Friday, and the index is expected to remain at 4.7%, a stronger than expected business confidence index for Germany for March fosters the problems of the central banks. Amid the empty economic calendar for the U.S. today, Wall Street sentiment will depend on the news on the banking sector and remarks by Philip Jefferson, a member of the Fed's Board of Governors. The US dollar index is hovering at around 103.10 and the instrument is trading almost flat, having shed a modest 0.02% against major currencies. The US dollar index is likely to trade in the intraday corridor between 102.70 and 103.50. The greenback is trading steadily on Monday, and the currency market reacted to softening jitters in the banking sector, with the yen's fall from the strongest levels in 7 weeks. Traders want to play safe as they cannot predict more negative news from the United States or European financial sector. The last 2 trading weeks were very volatile. Rate hikes by major central banks, hawkish remarks, and emergency rescue measures for ailing banks hurt the US dollar. Despite the fact that Jerome Powell opened the door for more rate hikes, the markets stand to believe that the regulator will suspend the cycle of monetary tightening at the next meeting. Federal Reserve Bank President of Minneapolis, Neil Kashkari, said on Sunday that the stocks in the banking sector and the likelihood of a looming lending crisis make a recession more realistic. Besides, investors reckon that the ECB will raise interest rates by more than 40 basis points by the summer and do not foresee the scenario of the dovish ECB, so a tougher rhetoric of the ECB than the US Fed makes the US dollar vulnerable. The Canadian dollar is strengthening amid waning concerns about the banking crisis and the US dollar's weakness. The USD card pay is trading at about 1.3710 or 0.25% down. The intraday corridor for the instrument is seen between 1.3680 and 1.3770, and the loonie was bruised by the pause in the Bank of Canada's rate hikes, accompanied by falling oil prices and a shock in the banking sector. However, the pause in the Fed's monetary tightening makes a gap between interest rates in the United States and Canada less severe. Meanwhile, oil prices reversed upwards because the full-blown banking crisis could be averted. Brent crude futures climbed by 1.3% to $76 a barrel, and WTI also recovered by 2% to trade at $70.65 a barrel. Brent jumped by 2.8% last week, and WTI rebounded by 3.8%. The oil market is likely to trade under high volatility on the back of ongoing headwinds in the financial markets, but analysts are bullish about oil prices. The reasons are obvious: growing energy demand in China and cuts in oil output in Russia. Russia's Vice Prime Minister Alexander Novak said that Moscow is about to hit its goal to slash the oil output by 500,000 barrels per day to almost 9.5 million barrels per day, and still Russian crude exports will remain stable. The crypto market is overwhelmed by the doom and gloom on a Monday. Lingering hopes for the classical financial system cooled down the optimism of the crypto fans. Nevertheless, digital assets have not pulled back from the recent peaks. Bitcoin slipped by a modest 0.2% intraday to trade at $27,700. Popular altcoins are trading in the red in sync, losing from a 0.4 to 2.6%. Ripple is the only strong performer with a solid 8% gain. Bitcoin is still trading in proximity to 28,000 and 65% higher than the levels of the early year. However, the banking crisis, which pushed the investors into cryptocurrencies, is ebbing away. So is the recent rally of digital gold. The crypto market retains its total worth at 1.16 trillion, killing its investment luster. Bitcoin has surged by 35% in the last 2 weeks to 28,000, and traders and authorities are staying abreast of the global banking sector. So they are anticipating the PCE price index and the Fed's preferable gauge of inflation. Before the crucial data, the crypto assets, like the conventional ones, will be sensitive to events and news on the banking sector. Crypto investors will also keep tabs on the remarks from the Fed's policymakers. You are aware that bad news for conventional assets is good news for Bitcoin. If the US Fed maintains its hawkish rhetoric, this is bearish for stocks but bullish for the flagship crypto. Without any stressful events, Bitcoin is likely to continue its sideways move in the range between $27,000 and $28,000. Good luck in your trading and see you online tomorrow.